Everybody, good to be here. Took a couple days off, needed a bit of a break. I'm probably going to be doing that a lot more coming up. I'm just getting really, really busy, and until I can, find the time to do this the right way, I'm going to take the time that I need. So anyway, I want to refer to a comment on a video I did called "What to Do After Big Loss." Marquis Seven said, like you said, I had no idea this could possibly happen. How do you explain these 6 to 7% down moves into $2 to $3 trillion stocks like Nvidia and Meta in the opening 30 minutes? Who's selling that? Institutions. Like, I don't mean to sound this way, but who cares? Who cares who's selling? The idea is that they are selling. Knowing who's doing the selling isn't going to help you manage the risk anymore. You need to have protective stops. And I'm not trying to pick on whoever this is or anyone else who might feel similarly, but this is where you can get hung up on things around trading that really have nothing to do with profitability, right? Because your job is to manage the risk. Now, I can't say even in my own career that wasn't a curiosity of mine, but when you really try to break it down, it has nothing to do with how you'll make or lose money, you know. And then the comment goes on and then 6 to 7% up in the next 30 minutes. Is that shorts covering or algorithms? No earnings, no CPI, nothing. They all trade sometimes worse than penny stocks. Well, the idea being is whatever the volatility is that you can have there's typically an inverse relationship between volatility and position size. If it's lower vol, meaning like if your R is constant, like that's the key, right? So if your R is constant and that's in the numerator, the volatility adjustment is in the denominator, the quotient is your position size. So just because something's volatile doesn't mean you can't trade it. Obviously, if you have a smaller account or you're underfunded, you might have to put things on the side or avoid. For me, myself, I've been short via puts, via many of these names because, the margin I could afford anything. But the truth is I don't want to, wake up. I don't want to have to be watching the clock, so to speak, overnight. As it is, I have to get up very, very early in the morning. And I just find it's a lot better to make the trade offs by owning puts because at least at that point I can understand what's the max loss on any particular trade. So that's a skill unto itself. If we were having this conversation 30 years ago, there was no way I could do it because I didn't have the time to really learn options. So the idea is you can look at ATR certainly as a volatility measurement, but if you're going to downtime and look at intraday, still use the daily ATR. I think it's a mistake to use an intraday ATR, which probably is not what you want to hear, especially if you have a smaller account. There's probably ways to look at things that are overbought, oversold, but that's not, for this channel. At the end of the day, the most important thing is to know what you're going to do. What are you going to do if the price of the instrument goes to a certain inflection point? Are you going to add risk or are you going to remove risk? We're going to talk about this a little bit, this week, and I'm going to explain how I look at it from an overarching psychological, an emotional standpoint. The tactical part's easy, so you can figure that out on your own. I don't want to, like I said, it's such a snooze to be looking at charts. You're probably like, dude, show some charts. No, I'm not doing it. That's behind that's for the premium stuff. The harder part is what we're doing here for free. That's why I do it for free. It's for you to figure out how to get your head on straight and figure out what your game plan's going to be. If you're attracted to things that are super volatile, then you have to position size for that volatility, also with the understanding that the volatility could increase while you're in the position, regardless of whether it goes in your intended direction or whether it goes against you. That's the trickier part. So, folks, if you're trying to pick bottoms or tops and you're not using the options, just make sure that you're position sized for 2x the vol, because that can easily happen. Might not happen in one day, but I've seen if you go look and call up anything on your favorite chart and then, put the ATR as an overlay, you can see that sometimes it might look like it's dollars and cents, but if you think of it in terms of percentages, it's actually quite profound. And I've seen in certain names where the vol's gone up 50%. So that's going to change your position sizing. If you're also in positions and the vol's increased, you can trim your position, right? So that you kind of have that constant risk on. That'll help you sleep at night, especially if you're taking trades home over the weekend or overnight. It's really, really important. To me, it's really at the heart of the matter of you developing your own emotional intelligence about how you feel about managing risk and how do you feel about, making and losing money. It all comes down to, understanding your own behavior. Worrying about how other people are going to behave at the open, we don't have any idea. The market has changed so much since I started, and there's so much electronic trading these days. The best you can do is really identify what's appropriate for you for what you want to do with your money. How do you want your money to grow? So instead of thinking about like who are the market participants, it doesn't really change the nature of anything from that standpoint. Whether it's a group of individuals who are selling at the open because they're scared, or whether it's institutions who are using any type of strength to move inventory into that strength, that's not my concern. You know, what you might want to consider is thinking about how do you feel about taking chances. And if you don't have a plan, especially if you're looking at like intraday data, which is very, very random, in choppy markets, you put yourself in a spot where you can get really ripped up because there's, at least to the untrained eye, it looks like there's no rhyme or reason to what's going on, which I think is the thrust of this question that came in. Is the person seems confused as to what's going on, but that's not necessarily relevant to what the person's behavior should be. Because if you're looking at charts and you're a chart reader, you should be able to ascertain where is it likely that you'd want to add risk, right? And where would you remove the risk given your tolerance for risk on a per trade basis? You see what I'm saying? Like who's participating in that on any given day is not necessarily relevant from a long-term profitability standpoint. Also to consider is like on any given day, the answer to that question can change. And so again, you don't want to be chasing your tail. You want to be able to understand like, okay, here's a setup or here's a pattern or here are my systematic rules that I'm going to follow day after day after day. And over hundreds, perhaps thousands of trades, I know that my rules have positive expected value. It doesn't really matter who is participating, whether it's Middle East money, whether it's institutions, whether it's algorithms. In the grand scheme of things, like it's a wash. You don't really care at the end of the day. If you just stick with your rules, you'll have a certain piece around what it is that you're trying to do, because all you have to do is replicate really winning behavior day after day after day. You're going to win some, you're going to lose some, like the rest of us. That's just the way God wants it, basically. If you like this video, check out this one.